Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how are you doing today?
I'm feeling all good in the hood over here, Joe. I'm feeling a little like I got my Smarty Pants glasses on today with our topic that we'll be covering today, which is a little bit more technical than we usually do. So I'm looking forward to geek out with our friend Yonah Weiss today. But before we do that, tell us the goods, Joe. I think where are you in relation to where I am? I think I have some news coming my way on that front.
Just a few miles away.
For the first time in a while.
Yeah, for the first time in a while. And my head might still be a little bit cloudy from jet lag, but I'll do my best.
And today is a Thursday, and you arrived home on what, Monday or Tuesday?
Yeah, we got back on like Monday at 6 p.m. and then tried to stay awake for the rest of that night and sleep. And so far, sleep has been going pretty well, the change has been going pretty well. But yeah, it's only been a couple days.
And so I think when we last talked, you were just into Venice or something like that, headed over to Milan to catch your flight home. Did you actually get to experience Milan, or was it pretty much a sleepover?
Milan, we went up to Como, and Como was cool. Like that was really fun. We did some awesome hiking there. They had some great food. And then in Milan, we basically just cruised into the hotel that was at the airport, which was super convenient, but we didn't do the city too much.
No stops at the CrossFit gym in Milan?
No, we went straight from Como to the hotel.
All right. Well, Joe is back, and you all are going to have an opportunity to see him next week. But before we tell them how they're going to be able to do that, I want to know, of your last 5 weeks between Israel, Italy, what one thing was your favorite thing? One thing.
There was this hike that we did in Amalfi that was basically seemed like it was kind of through somebody's backyard. Like you understand, but it's really hard to explain if you haven't been there before. You're like walking down this path that's in this mountainous region that's through these like farm /
Yet you're on the Mediterranean Sea.
Yet you're like, at least 100.
Bay of Naples in Amalfi.
What's that?
Bay of Naples.
Yeah. So then you're hiking up, and you can get access to all these hiking trails from these like brick paths. And this particular one, we went over this brick bridge, and it seemed like through somebody's backyard / farm, and up into this, a few hundred feet up into a place that had these old ruins from where they would, have to have lookouts for people making attacks from the sea, which are all over that area. And it was just fantastic. Like you could see where the people were living, and then like where they had the lookout, and there was nobody there. It was amazing. Like we were the only two people on this amazing hike with the view of the sea, with the view of the villages, with the ruins. It was just unbelievable.
Nice. We'll call that a natural high, no doubt, for sure. Well, that sounds good. And if you guys are all, this kind of ties into our topic today, which our topic today is we're going to go deep dive into cost segregation. But on Tuesday next week, or I don't know, I guess this will drop later, won't it? So that doesn't make sense, right?
Yeah, it will.
Yeah. So I hope you guys all enjoyed, let's just say, our recent quarterly event with Drew Niffin. Hopefully you made it out there, which was covering multifamily investing and underwriting and syndication and coaching and all that stuff. We just had a spectacular, I'm projecting that, we just had a spectacular event with our buddy Drew Niffin, who I assume probably also might be a client, maybe not, of Madison Specs LLC for cost segregation, cost segregation studies, which is what we're going to talk about today. So let's jump into it. So we stop goofing around here. Today I'm going to introduce you to some of you, a couple of you I know already know Yonah Weiss from Madison Specs LLC, which stands for Specialized Property Engineering and Cost Segregation. So Yonah, what's going on?
How you guys doing? I'm doing great today.
Yeah, and you know what the crazy part, guys, is? Yonah, tell us where you are.
So I guess Joe just left Israel, but that's where I am. So we just missed each other by like 2 weeks.
Yeah.
That's right, guys. SIC, the Nuts and Bolts of Real Estate Investing, is officially an international podcast guest. We're reaching to the stars here. That is so cool that you are there. And Joe and Yonah were having a little shop talk here on their adventures in Israel. So weird how the synergies we were talking about can be after we're all hanging out and in these same communities and all this stuff. So, but let's jump into it. Madison Specs they are part of the Madison Commercial Real Estate Services Group, which provides comprehensive suite of real estate services, including, and the big one is cost segregation, which we're going to talk about with Yonah today. So we're going to find out what makes them different maybe from other cost segregation companies, teach you guys what that is, when you might want to apply that, or look for projects where you can apply it. But welcome, Yonah.
Thank you again. It's really my pleasure. I appreciate. I'm going to shout out to Ryan Gibson, great guy, self-storage aficionado, who introduced me to you guys.
Exactly. We love you, Ryan. Shout out to Spartan Investment Group for introducing us. So we're going to let Joe kick us off with our usual suspect first question. Then we'll roll on and see what happens here.
All right, here we go. So the first question is, take us back. We want to know where you grew up, how you grew up, and how that got you or led you into being a cost segregation specialist.
So I grew up in Southern California, and just another weird thing that Joe and I both went to San Diego State University.
Yeah.
We even overlapped 1 year over there. So, and then actually, just fast forward, I spent about 15 years in studying and in education, teaching various levels. And just fast forward, because that really has a lot to do with, how I got into cost segregation and got into real estate investing in general, is that I'm just a learner, a lifelong learner. So I love to learn. And the more I heard about real estate from friends, it was just something that was fascinating to me, and I wanted to learn more and more and more about it. So I actually got my broker's license, and I wanted to get involved in residential real estate. And then I worked for a commercial mortgage broker for a little while, learning the industry and underwriting and stuff like that. Just wanted to soak up everything, and which led me to connecting with this amazing company, Madison, who are just amazing people. And it's more about the company than anything else, but it seemed like I just fit in like a glove to what was needed at the time, which was someone to kind of come in and provide educational reference and services for the masses, because cost segregation is something that almost nobody knows about. And even if you do know about it, you always have like 100 questions. Like, well, what about this? And so we're going to try to cover as much as we can today on that to make it as clear and as simple as we can. But it seemed like natural ability for me. We have some of the top engineers and accountants in the industry in our company, a team of over 60 individuals. And so I was able to really just soak up like a sponge, everything from them. And, just love doing podcasts like this.
What's interesting, I'll say about what you said, which I was thinking, which I find to be so true, right? So you got a bunch of coneheads, which we'll call engineers, CPAs, and all that stuff, right? And they are spectacularly smart at making all the calculations and doing all the work and stuff like that. Kind of like, we'll say like a doctor, right?
Right.
But yet maybe they're not necessarily as skilled in teaching somebody how to do it or talking about it. They can make it happen and do it, but to actually explain to somebody eloquently, as I think we've all just recognized how eloquent of a speaker that Yonah is already, and you're the business director, right? So what's awesome about that is you get to go out and teach everybody because that's your wheelhouse, that's your comfort level. And then you have all these CPAs and engineers in there actually cranking out the work, which might be potentially less eloquent in explaining and kind of talking about cost segregation and the services of your company, which go pretty far deep beyond cost segregation. So I think it's cool, right? That you don't have to be the guy that is the engineer or the CPA, but you can still get involved with something like this in a different way. I think people forget that there is a massive skill set and be able to talk to people eloquently and efficiently. And
Right.
I can't wait to hear your flow today because I enjoy that myself. So,
Absolutely.
well, maybe let's just start off with the simple starter version here as we kick off. Just give us like the general benefits of cost segregation, just in general, a brief overview of what that really means for.
Right. Absolutely. So first of all, weird name. Okay. Let's just get over the hump. Like, I don't know why the IRS chose this name for really what it means is depreciating a property and breaking out the different costs or the different components of the property to different depreciation lives. So segregating the costs, I guess, of the building. That's why they came up with that. I still don't like it, but we'll just take a step back and just describe depreciation because most people know what that is, but with a clear understanding of depreciation, we can get a much clearer understanding of cost segregation, which otherwise people refer to it as accelerated depreciation, meaning taking faster deductions. So depreciation is a tax deduction. Any and every real estate owner for investment property, business property, gets this deduction from their income taxes just because they own the property. So it does not include your personal residence. Unfortunately, you don't get a tax deduction because you own a property, own a house. But if you own an investment property or a business property, the day that you buy that or you place it in service, meaning it's ready to go, ready to rent for the first time, if it's like a new development or something, right? It doesn't go when you buy it, but it goes when you place it in service. We take that value, that amount, that dollar amount that was spent, and that is your depreciation. Okay, we always subtract a little amount, whatever that is, for land. Land is not depreciation, but the building and everything that's in the property has a value. So let's say you buy a property for $1 million, right? Subtract, let's say, 15% for land. You're left with what's called a basis of $850,000. That means that now you can go ahead and take that entire amount as a tax deduction. But you don't get it all at once, unfortunately. So the IRS gave some really kind of arbitrary numbers, and they said a commercial building depreciates over 39 years. So that $850,000, if it's a commercial building, you have to split it up into, 39, and then every year you get about $20,000, $21,000 or so of deduction each year. For residential, which also includes multifamily, it's 27 and a half years, which means it's more like about a $30,000 deduction every year for 27 and a half years. And that's really how it goes. That if you make money from your properties, you right off the bat get a deduction called depreciation. Okay? So far, I think it's pretty clear. Great deduction. You own property. IRS gives you a tax benefit, right? You don't pay tax on that amount. Next. Yeah, so far so good?
So far so good. And that's a non-cash, you're getting this deduction. You've already spent the cash when you bought the building, and now you're getting this non-cash deduction every year, if that makes sense. Does that make any sense what I'm saying there?
Yeah, totally. Because now your income from the property, you get to just deduct a certain amount so that you're not taxed on the full amount of your income. So it's so now comes in cost segregation. So there are actually things in a property that depreciate at a faster life than these 27 and 39 years that we discussed before. So there are two main categories of things, and this is really where cost segregation comes into play. There are things in the building that's called personal property. Okay, the tax code is 1245 if anyone wants to look that up. But personal property really includes almost anything in a building that's not part of the structure, right? Or not needed for the main structure of the building. So that can include anything like, simple things like appliances and furniture, right? Really clearly that applies, but also stuff that most people wouldn't even consider to depreciate at a 5-year rate, which is what this personal property depreciates at, like carpeting, okay? If you have like partitions or certain fixtures, special purpose lighting, you can have stuff like millwork or window treatments that it's part, you don't even look at that. You think it's all just part of the building, but actually all of that depreciates over a 5-year period. And conservation comes into play. You actually need an engineer, according to the IRS, to go and identify what all those things are in the property and identify the costs, okay, the value of each of those things based on industry standards. And then you can actually take those deductions based on that value over those 5-year periods. So what we're doing is breaking out or reallocating a certain amount of the value of the property that you purchased to a 5-year depreciation instead of a 27 and a half or 39.
We're trying to accelerate the depreciation, which write-off sooner rather than spreading it out.
Exactly. So that's the first category. And the second category is land improvements, which depreciate over a 15-year period. And this is really huge because, right, we said land does not depreciate. So, your building sits on a land. The land, you don't get to depreciate the value of that, but actually what's on the land, like stuff like pavement, if you put in a driveway, you have parking spaces, that actually has a value to it and depreciates over 15 years. Also landscaping, fencing, a playground, anything that's outside the property, basically, swimming pool, all that stuff has a value, depreciates over 15 years, right? So we're going to reallocate and front load those depreciation deductions to get more deductions earlier on in the life of ownership.
Exactly. And as a multifamily building owner and commercial, I've owned office buildings and all that stuff myself. The beauty of it is when you accelerate your depreciation and you tack on some other stuff with your amortization of loans and stuff like that, you can cash flow money in your pocket on these buildings and still have a tax loss.
Exactly.
Right?
Exactly. Meaning you can spend, let's say you spend 20% down on a property, all right, you get the rest as financed. You can literally get, and especially with the new tax law, which we'll talk about in a second, called bonus depreciation, you can actually get in the first year like a 20% write-off. So basically all the money that you actually spent, you can get back as a tax write-off the next year.
That's crazy biz. This is all about knowing what's up, guys, and knowing to ask the right questions and having the right players on your team. Again, you don't have to be an expert at this. You just have to know who the expert is, right? Exactly. Let me ask you, do you guys have a service, just kind of breaking it down based on what we've talked about so far? When somebody is buying a building, to help them get the right allocation between the land and the building, or is, you know what I mean? Because that's part of it, right? Maybe there's opportunities to be seeking out, right? Where there's investment properties or projects or land or you can buy where the allocation is not correct. And therefore, if you can get that land building allocation reallocated, you get a nice bonus off the front.
Right. Totally. Yeah, there is, we definitely do some advisory in that regard. But what we do, which is actually a really great service, is we'll provide an upfront just analysis of any property for free. So if you're like under contract on a building, you just want to see, hey, what are the potential tax savings, tax benefits I'm going to get on this? You can see right away, our projections, even before an engineer goes there, just based on the thousands of properties we've done, we can give you those projections right off the bat.
That is spectacular. So what types of asset classes would benefit most from a cost segregation study?
Oh, great question. Yeah, because it really depends on what's in the building. So there are certain asset classes that have more stuff. Generally speaking, between I'd say 10 and 30% is usually like the window of the amount that's reallocated to a faster life, to get those faster deductions. But something which we have a lot of clients that do assisted living or senior living care facilities where there's tons of equipment and beds, electronic devices, equipment, stuff like that that's in each room. All that stuff has tremendous value to it. And so there's a larger amount that's actually allocated to that versus the building, the structure of the building. So that's one that has a high percentage. Apartments
low then would be like a warehouse.
Yeah, so exactly. So like a warehouse would be like the least amount.
Right.
It would be the least amount. It could be literally, depending on what's in there, it could be almost nothing. I mean, it may not even be worthwhile to do. Now, we have done tons of warehouses, but usually, there's got to be number one, like a large parking lot or something like that gets you the 15-year property that's reallocated. Right. And then even the building, there can be stuff like, different types of mounting, and it really depends on what type of warehouse it is, right? If it's just like an empty warehouse, that you just store shipping containers or whatever, it's not going to be much of anything in there. But we've done a number. We have a big client who does, a distribution center. So that's a whole different level of warehouse where the major high-tech equipment that's going on inside the building, and there's tremendous value there. I mean, we did for him one of the 1 million square foot Amazon distribution center in Florida. So
yeah, and just to clarify, the equipment and all the personal property that's in the building or whatever structure we're talking about must be owned by the owner, not the tenant, right? Because lots of buildings we're talking about have tenants, and they might own some of their own equipment. We're talking about owned by the property owner owns the equipment, correct?
Correct. Yeah, that's absolutely a good point. Now, there are many cases where the tenant will require like a build out that the owner will foot the bill for, and in that case, then the owner will get it. But on the flip side, actually, it's great that you brought that up, that if the tenant has such significant equipment in the building, the tenant himself can do the cost segregation on the tenant improvements.
The tenant themselves on their own
equipment
or whatever, right? Their own business stuff.
So yeah, exactly.
Yeah, awesome. I didn't think about that, right? So as a tenant in a building or whatever you are, you also, as an owner of a business, can use cost segregation for your business.
Correct. You can get a lot of those deductions earlier on. I mean, it's really more about allocating those amounts as opposed to, to get those deductions, as opposed to writing them off, or as opposed to, not even thinking about that. You get a tax deduction for it, which a lot of people don't even take into consideration. They spend all the money and they don't, take the depreciation.
Right. So what's the optimal time to perform a cost segregation study? Obviously during construction, or maybe I'm wrong. Maybe it's less about that because it's more about what's in the building, not the building itself. Or tell us, seems like you would, during construction of something, or actually thinking about this as you're, I don't know, does it have anything to do with choosing materials, or is there some part of it that goes along with building a building? And then how does it work with existing buildings?
So the depreciation from a property starts from when it was placed in service. So it means it already has to be ready to rent, or, tenants in there existing when you acquire a building. So, it's most advantageous to get it done immediately, so you get those tax deductions in the first year. So that's the most common time when people do the cost segregation study, is usually immediately after acquisition. So they can get the deductions based on the building as is. Now, if you're going to go and do major renovations on the property after you've already placed in a service, you bought the property, and a lot of people do, right, a value add. Okay, they'll do, they'll rent the apartment building and they'll renovate all the units. They'll put, they'll pave a new parking lot, right? They'll do all kinds of improvements. You can actually double dip, meaning you can get double depreciation deductions based on the acquisition. You take that entire building, you depreciate it based on how, and you cost segregate it, get those extra depreciation deductions earlier on. Then you dispose of whatever you're disposing of. When you put in the new equipment, or the new, in this case, appliances or furniture, or, put in a new kitchen, new flooring, whatever it is, that stuff, it's 5-year property, you can actually write that off in a 5-year period. And
Right. So it's like you do an initial cost segregation, but then there's like a what is there, an annual update, as you do your taxes every year?
Yeah, I mean, if a person is doing, significant renovations every year, it's usually not the case. But yeah, as soon as you're doing significant renovations, then there is, an update, like it's like an additional study at the fraction of the cost, but it's something that just goes and discusses the renovations and all the money that was spent. And
so we used to, back in the day when I was doing all this kind of stuff, we would, as new carpets or as anything new was being installed, we would write the date, month and year on the underside of the carpet, for example, right? Mm-hmm. So we knew what the year it was installed, so we had record of that kind of stuff. That's good. Maybe, I don't know if that makes any sense in an overall cost segregation study, but in regards to just property management in general, when you're trying to, determine how much somebody damages the carpet and, they want to argue with you about it, whether it's new or a year old versus 4 years old can make a difference, especially if you have proof, right? So I don't know if, with cost segregations, is there like you need to have a certain volume of renovation activity for it to make sense, or that's the initial study, and then yearly, do you need to be doing a certain amount, like an apartment building, for example, multifamily, you're going to have turnover every year. You're going to replace carpets and appliances most likely every year, right? Is right. It that you did a big rehab and you do your cost segregation as part of that? But do you follow up? I'm still trying to clarify my understanding. Do you follow up every year with a little, you replaced, 25 carpets in a 200 unit building? Do you do that kind of stuff? Or is that small potatoes after the fact that you don't focus on?
Yeah, it really depends. It really does depend on how much the spend is and what the benefit is going to be by getting those, extra deductions. You're definitely going to capitalize the expense. And so that's going to be added to the basis of the property. That's going to be added to the amount that's depreciated. And, obviously if it's significant enough that it makes sense to, accelerate that to a faster life, then yeah, we'll go ahead and do a follow-up on that follow-up study.
Awesome. So what size of buildings, like as far as apartment buildings, or how much square foot of like an office, does it work with retail, I guess, too? I mean,
everything, believe it or not, every
right?
type of property, any and every type of property. There's really no type of property that is not beneficial. Like we discussed warehouses, but even if the warehouse is totally empty, there still may be some stuff in there that's beneficial, especially depending on how much the purchase price was. You want to get whatever tax benefits you're allowed to take. So it's definitely worthwhile looking into. But yeah, retail, office, shopping centers, hotels. We've done tons of, even golf courses, right? So this is a great one. Most people don't even think golf courses are anything because it's just land, right? Land doesn't depreciate. But believe it or not, golf courses are considered the majority of it land improvements because it's landscaping. And so all of that is 15-year property that depreciates on a 15-year scale.
Yeah.
So we're talking about sometimes 70 to 80% of the value of the property goes into that 15-year category instead of 39 years. So that's a huge one.
This is kind of a weird question. What if somebody owned a 250-unit mobile home park?
Yes. In fact, I was just about to bring that up because mobile home parks also, it's the same exact thing. If you own, let's say there's really two scenarios, okay? I mean, there's really three, but there's park-owned homes and there's the tenant-owned homes. And then there's, some sort of mix, right? But usually people are going into mobile home parks, correct me if I'm wrong, but, as few park-owned homes as possible, if none is ideal.
Right.
So essentially what you're buying is just the land which consists of the same thing, 15-year property. These are the concrete pads under each home. That's yours. Okay, so basically, mobile home parks are the majority of it actually can be in that 15-year category. And I'm going to bring it up now because we didn't mention it. I kind of mentioned it briefly, but it's very applicable here, which there's a new tax, a law in the recent tax reform, the Tax Cuts and Jobs Act, called bonus depreciation. And that comes into play very much here when we're discussing the mobile home parks, because bonus depreciation, it's called 100% bonus depreciation, which means it allows you to take anything that depreciates less than 20 years. So that's all of our 15-year property we discussed, land improvements, all of that 5-year property, the personal stuff that's in the building and not part of the structure. All of that you can choose. You have the option now to take the entire amount in year number 1. Wow. So instead of like accelerating, 10% into the 15-year category and another 10% or 20%, whatever, into the 5-year category and getting for the first 5 years a huge chunk of extra deductions, now you can front load the whole thing into year number 1, which is huge, which is a game changer, which is why I wanted to bring up with the mobile home parks. Let's say your mobile home park, is 70% 15-year property, which can be very common. So, let's say you buy a $5 million mobile home park. Okay, you're talking right off the bat, of like a $3.5 million deduction in year number 1, right? You just put down, like I had a client, Springfield Communities. They're a great group of guys out of New Jersey, and they, buy mobile home parks. So I was in their office a few weeks ago, and the guy's like, Yonah, you have to explain to me how I spent $3 million on a mobile home park, which, only 20% of it was his own money, right?
Yeah.
And he said, and the first year I get a tax deduction of over $1 million. How to explain that to me? Like, how does that work? So this is exactly what we're talking about here. The guy's like, I had a guy on the phone yesterday who was in tears, literally, at hearing the news that he had such a huge tax deduction. It was like he was moved to tears. It was so incredible. Like, wow, had no idea that he would not have to pay taxes this year. So that's like, it really gives me joy to do this work.
I'm feeling the joy coming right through here. But let's talk about step 2 beyond that, right? That sounds super, super awesome. But we want to remind everybody that if you write off depreciation, if you go to sell it, there's something called depreciation recapture.
Absolutely.
Right. And so that's like the other side of the coin here.
Dark side of depreciation.
That is the dark side. I myself have owned an apartment building that's like 200 units for long time. And I literally could never sell it now because was fully depreciated, and my tax bill is, about $600,000 at this point, if we were to sell it, now hopefully we'll never do that, but it's that part, and what is that tax at right now at 25%, or something like that on the recapture?
Yeah. So the recapture doesn't mean you have to pay back the entire depreciation, which some people actually think that's what it means. It means you pay a tax on the amount of depreciation that you took, or what's called really uncaptured depreciation. But there's good news, because if you do a 1031 exchange, you can actually further defer that depreciation recapture tax as well.
Absolutely.
Besides for the capital gains tax that the 1031 does. So there is some hope, that you can just push and push and push, it all. Or as we actually have a sister company, Madison 1031, and one of our qualified intermediaries, one of the counsels in there, he tells me he likes to call it, swap till you drop. Just keep doing it until the end of days.
Right. I mean, it's a package. You need to know about that. That's part 2 of your life when you're playing this game. And so, does that mean though does it make sense that that you would want to hold a building for a certain amount of time when you're doing this, or you have to have your recapture plan in place, your exchange plan in place? Does it, most people, I would say, that are buying buildings like this, I don't think they're necessarily flipping them, but we do have friends that do flip commercial. One of our friends, Sean Katona, who we're hopefully going to have on, just made like $2 million flipping a commercial property, not too long ago or something like that. I mean, we'll hear hopefully directly from him how that went down. But what do you have to say about, length of time of hold as compared to having a cost segregation study done, which does cost money. I don't know how much. Maybe you can let us know, right? Is there a balance there between hold, cost, and size and all that?
Sure, absolutely. So we'll talk about both topics now because they're very important aspects of this. Number one, the time, sometimes it's going to be relative to the strategy. Everyone's got a different strategy, but generally speaking, I don't recommend doing cost segregation unless you're planning on holding the property for at least 2 to 3 years, because essentially because of the depreciation recapture tax that's going to come back right at you, almost immediately. So that's something to keep in mind. Longer term holds is definitely going to be valuable. And I said it's relative because if someone is buying a lot of properties, okay, then it's really a game, okay, of how to keep your tax liability down every year, right? Here, next year, you're going to buy another property. You're going to do more cost segregation. The losses that will come from that can actually be used to offset the capital gains or the depreciation recapture tax if there's enough losses carrying forward. So there's actually a big strategy.
That's a nugget. That's a little nugget that you just said.
Yeah.
You're saying that the depreciation from another building, let's say you're a baller and you own a bunch of buildings, right? Which we all want to be, that the depreciation off one, that's first year, let's say you're selling another one you've held for 3 or 5 years and you have some recapture going on, and then you're buying one and you're getting this huge bonus depreciation, can offset the 25% recapture tax on the other one.
Potentially, yeah. And I want to say potentially with a caveat because it's not like right off the bat, because there are rules in terms of what the depreciation is allowed to offset and when and how much. So if you're a real estate professional by IRS standards, which is, if someone's in real estate, you should make sure you fit into that box because it's going to allow you to use depreciation to offset, all of your other income and potentially going to be used to do what we just talked about. But if you're not a real estate professional, then there's going to be a huge limitation. You're only going to be able to use the depreciation to offset the income.
I got what you're saying. Property. So you guys all who are listening, you need to be aware and talk to your CPAs about making sure if you qualify to be designated as a real estate professional, which means I think that you have to spend a certain number of hours working in real estate or something like that. I don't know what the definition is.
There's 2 qualifications. One, you have to spend more than half of your time, your working hours of that year. So 51% of your time has to be in the real estate industry, doing something, whether it's managing, buying, selling, constructing, developing, etc. And it has to be at least 750 hours a year. So you can't just be a real estate professional, only own real estate and sit on a beach all day and still get that status. You actually have to, document some working hours. So those are 2 qualifications. I highly recommend everyone trying to get this status because, like I said, you can use the bonus depreciation. You can use those huge, massive deductions to not only offset the income, your income tax liability, but if there's enough left over after it's already hit your income tax liability, then whatever's left over can be carried forward and then can be used to offset, depreciation recapture, even capital gains.
I get it. I have lived that life myself for the last, 20 years or something like that. So very powerful. If you're buying real estate of the size of the deals or trying to get into doing the deals like this and you're not studying everything that Yonah is talking to us today, you almost get a slap on your hand that you shouldn't be owning those buildings. You gotta learn the other side of, people focus on the buy, sell, or the renovate or the construction. And, me and my friends here in the Pacific Northwest, my smarty pants friends like Ryan Gibson and some of my other friends were like, the conversation is backwards sometimes. And people need to know about lending and borrowing and, taxes and that whole thing before they even start, honestly, learn that first. And so hopefully this will be part of your education today, guys, as we continue talking on here. Let me ask you, what are like the areas of cost segregation that are the toughest to calculate or determine? Are there things like, I think I recall back in the day that our CPA was like, here's your accelerated depreciation for your appliances and your carpets and this, that. Never had the conversation that was too detailed and ninja, but I imagine you guys are so dialed and such experts that what are the little ninja write-off or cost segregation acceleration things that people wouldn't think of as a fun little side?
There's so many things. I mean, it's incredible because until an engineer actually comes to the property and shows you what's there. But I'll give you one example, like something like carpeting or vinyl flooring is considered 5-year property. It depreciates over 5 years, and it's not even part of the structure, even though theoretically it's part of the structure, right?
Right.
But that actually depreciates at a faster rate. So the value of that carpeting and flooring is usually a huge ticket item in the building, very valuable. Other things.
What if you go in and you put in like washer and dryers in a unit? Does that mean anything?
Yeah, all of that, yeah, for sure. All appliances, all furniture is all 5-year property.
Right. I guess some of the things I wouldn't have thought about are the parking lot.
Right. Exactly.
Things like that, which is an interesting thing. Things that you do that you would make, fencing. That's one I would never think about. Landscaping, I would never think about, right?
Exactly, right. So there really are so many things. It's hard to know. But one question you asked before, and I actually pushed it off because we were talking about depreciation recapture. But you asked like, how much does it cost? What's the cost of this to do? And like, what size building is really worthwhile to do it on? So I'll just go ahead and answer those because it's probably the most important question, right? The listeners out there want to know, hey, does this apply to me? Right? I bought a building. Is this going to be worthwhile for me? So I want to just go in and tell you, I generally don't push this on any property that's bought for less than $1 million because, and it really doesn't have to do so much with the square footage or even with the size of the building or what type of property it is. Well, it does in a way, but since we're just front loading, we're reallocating certain percentages. So it's going to be a percentage thing, meaning it's going to be only relevant if enough of that percentage is reallocated from that amount. So $1 million, you're definitely going to get significant benefit. We're talking about $50,000 to $100,000 of net present value, like benefits, right? So that's the fee. Usually, all firms are different, but no one's created equally. But we generally charge, somewhere between $5,000 and $7,000. Sometimes less if it's a much smaller property, sometimes more if it's a bigger property. But that's the basic window, and it's based on the scope of work and the size of the building. So even if it's a $20 million property, right? But it's a multifamily or whatever it is, the fee is going to be the same, whether you're getting $2 million of tax benefit or $20,000 of tax benefit. The fee is going to be the same. So that's basically my answer on those two points.
Makes sense. Absolutely makes sense. Let me ask you a question. So let's say somebody owns a building, they did a cost segregation study and they benefited from it and whatever went on there and they're all happy but they sell the building. Now that new owner, that there's no transferring or it's not related because now it's a new price, a new amount to depreciate. Just to be crystal clear on that, there's no benefit from one seller to a new buyer. It starts all over, right? And that means that, let's say the previous owner depreciated carpets and appliances or whatever else. That's their taxes. Now you start over, you buy a building that has carpets and appliances.
Yeah, it starts over. It's crazy. It starts over when you buy a property. So it's like one of the reasons why this whole thing is like taxes are really just like theoretical. It's not based on real logic. It's really based on whatever like theoretical laws they came up with. So yeah, that's one of the incredible things about this.
Exactly. So let's say you have a commercial building like an office or retail or whatever, and you're a property owner, and there's, let's say it's a medical dental building, and you're paying for improvements to build out the space. And, let's say you've owned the building for 10 years or however long you own the building, you're going to have maybe some turnover there, and you're going to have some tenant improvement costs related to that you're paying the bill for, or you're amortizing it back in their rent somehow. Again, that's the annual review, right? Of, do I have enough? Is there something here going on that I should do an additional cost segregation study because I just, had 40% of my building turnover last year and I had to do new improvements for the new tenants.
Mm-hmm.
Does that make sense?
Yeah, totally.
And how does that work? They just come and do an extra little side study?
Yeah, we'll give the engineers will look at the the construction budget, what was done, and see, based on that, all the line items broken out, what's there, and be able to, come to the property and then see what the differences are and break that down.
Awesome stuff. And so have you guys ever been called as a consultants for like an IRS audit because somebody's IRS is, giving somebody hassles about their write-offs, and then you guys are consultants on that? Or I know you provide a huge amount of documentation on all that.
So we haven't ever been called in as like a third party, for that. On the number of times where our clients have been audited for other reasons, the funny thing is we don't even really do anything. There was one occasion where we actually had to kind of speak on the behalf, but because there was one point that needed to be challenged, but everything was no change, 100% no change from the IRS. So in all those cases, because there are such clear guidelines given by the IRS with the cost segregation audit techniques guide, it's actually out there. You can Google it. There's such clear guidelines that we follow it to a T. So it's basically the study that we prepare is like, 100 pages long, and it has everything in it that they're looking for. So I don't, believe it or not, I don't want to give too much credit to the IRS, but I don't think the auditors are necessarily know exactly even what's in there.
Right. Exactly. And you know how people can amend their tax returns and stuff?
Yeah.
Is there any, you have to have, you're not going to like do a cost segregation study and then go back and amend anything. It would just be, is that right?
So there's actually much better. So amending your tax returns is really never a good idea this it usually, goes under the scrutiny of the IRS. If you amend a return, they're going to look at it. But if you, this is unbelievable. This is a mind blower. Okay. If you didn't know this already, you're just about to get your mind blown. You can actually do cost segregation retroactively on a property that you had been doing straight line depreciation on for years. You can now go ahead and do it retroactively without ever having to amend your tax returns.
What?
So there's a form that needs to be filled out, which is called the 3115. It's a form that goes along with your tax return and basically says on that form, it's called the change of depreciation method form. So you're telling the IRS, I did depreciate it straight line until now, but now I'm making an adjustment and I'm doing it in a different way. And the reason why they don't, really scrutinize that, because believe it or not, and this is the craziest part, cost segregation is actually considered the correct way of depreciating the property. So doing the straight line method, which almost everyone does, if they're not doing cost segregation, right, is actually considered the improper method of depreciating a property. Nevertheless, the IRS isn't going to call anyone out on it, right? Because that means more money for them when people aren't taking.
That is fascinating and absolutely makes perfect sense when you say it that way. Right?
Yeah. So that's something a lot of people know. And so you can actually do it retroactively. You can go back, 5-10 years and get the extra depreciation deductions that you missed. And it's going to be like a huge lump sum in the first year. So like, for example, someone who has like a huge tax liability 1 year, he may not have needed cost segregation in the past, but this year he's got a huge tax liability. Hey, guess what? Here's a way you can do cost segregation retroactively, get a huge lump sum in that year, and that's going to help you out.
Wow. Good stuff. That's good stuff right there. That is, I can't even talk because I'm still processing it, what you said myself. Well, what else? Anything else that we need to know before we wrap up? And I want to like touch on some of the other services that, Madison offers, because I think it's sort of just interesting. Like you have a group called, what is that? Real Diligence LLC, which actually we hire somebody to perform the due diligence on your property. Do you know about these other business lines?
Yeah, sure. Yeah. So we have a number of other services. The biggest is actually a title agent. We're a national title agent, one of the biggest out there. But yeah, this it's called Lease Probe Real Diligence. So it's two companies kind of join forces into one, and they really complement each other. One is Lease Probe, is a lease abstracting company, which allows, it takes a commercial lease, which many times, let's say a commercial building, office building, a retail building may have, a number of leases in it, sometimes hundreds of leases in it, and they're all commercial leases are not like residential leases, okay? They're extremely long, very detailed, and most of the time old. Most of the time people don't update the leases when there's a change of ownership.
And very custom, so each one can be different.
Exactly, each one can be different, and many times they don't necessarily even match the rent rolls. So what happens is you'll have something called a lease abstract. So that's what the company does. And we have, a team of a few dozen professionals that are trained in this to do this all day long, every day. Usually when one would want to get a lease abstraction done, they would go to their lawyer and say, hey, I want you to check out this lease and break it down and make sure it's all right. Read through the entire 120-page lease. Yeah, right. What lawyer is going to do that, right? They basically farm it out to the junior lawyers who obviously don't have training in it. And many lawyers have told me themselves when they were in law firms, like once a lease abstraction would come, there'd be like a company email, like who needs billable hours, right?
Yeah.
Like
so
no one wants to do
this is in order to confirm the actual lease to the rent roll information to make sure they match. Is that what we're talking about?
Exactly. And yeah, exactly. And many times, almost always, we're talking about huge discrepancies,
right,
are found. And so there's tremendous value in this. And the due diligence that we do, also financial due diligence, environmental due diligence as well. So these are other services that go along, kind of complement one another in that.
But this is money that people are spending. They are spending during their purchase feasibility period.
Usually, or a lot of people will just do it afterwards because they bought a property and they just want to make sure that everything's right. I mean, you want to make sure that some things aren't accurate. And you know what happens? Just give you a prime example. You may have the previous owner was given certain leniencies to the tenants, but that's not what it says in the actual lease. So that's, the tenants may not be fulfilling their obligations because what says in the lease, which the new buyer, he assumes that everything that's written in the lease is supposed to be. Okay, everyone's supposed to keep to their terms, but maybe in many cases there are leniencies going on. There are things that are not being kept up, and so there are many, tens of thousands of dollars, left on the table.
Heck yeah, I have a good example of that myself. I owned a office building in downtown Seattle. I was a smaller partner, but in a big building is still okay with me. But I was the operations, asset manager, let's say, running it. And we had a tenant. The actual building was actually named after the building was named after the tenant. And there was this big open area of common space. We'll call it sort of tables and chairs where people could hang out, which was clearly always being used by this one particular tenant. And we sold this building, huge profit margin, but the entire deal clinched upon the fact that we were able to get them to start paying rent for this space they'd been using forever, which was, they were using it without paying for it because of the discrepancies in the lease, but yet almost like leniency from the previous owner.
Right.
And it literally was the difference in millions of dollars on sale price when we got them I remember just sitting there sweating it out, trying to negotiate this lease to try to get them to start paying for that space. And if we could get them to, we already had the buyer lined up, and all I needed for them was to sign. And guess what? It happened. So that's exactly that type of situation, right? It's probably so common too, right? What a great ninja way, if you are able to, if you are an investor out there and you are able to say like, sure, I'm interested in buying your building. And if there's any way for you to get a copy of the leases and all that stuff, I guess you can obviously have that during your due diligence period. But if there's any way for you to ever get copies of leases ahead of time, when you're thinking about making an offer, because some mom and pop owners will hand them over.
Yeah.
What a ninja way to find, instant equity and opportunities, right? Is to get copies of those things and compare them to rent rolls, just as you say. So, well, wow. Well, I think it's pretty obvious and clear that we ourselves, it's great for us to be aware. I think our job as investors, guys who are listening, is to know that these types of things exist, that cost segregation exists, that, you need to know about your tax liabilities and depreciation recapture on the other side of the coin. You need to know these things exist, but you sure as shit don't need to be the expert at it, because we have awesome services like, Madison, which a lot of our friends already use. And we're just making sure that all you guys are aware of this by having Yonah on today, that you can just hire these guys. If you look at the overall cost to the benefits, it's a no-brainer, right? An absolute no-brainer. The important thing is that it exists and that places like Madison Specs are available. And as like Yonah said, there's a free, what was it? They can get a free look. Is that right?
Yeah. Basically a free look, a free, we call it a feasibility analysis, but it's basically just getting the estimate of what, what you're looking at.
Is there anything else you think we should know before we let you get back to enjoying your time in Jerusalem?
I think that's it. We covered so much, and there's really there's a lot more to learn, but everyone can feel free. I'm sure you put my contact information out there. Feel free to reach out to me if you have any more questions, because I'm available, and this is what I love to do, and love helping people save taxes. It's a passion of mine.
And so how do people get in contact with you, and give us the website where they can learn a little bit more before they reach out to you?
So best way to do it, believe it or not, check me out on LinkedIn. I'm actually extremely active in posting content all day long on LinkedIn. You can go to madisonspecs.com, or you can email me directly at yweiss@madisonspecs.com, and feel free. Check me out.
Awesome stuff. And guys, we have a lot of people within our own community that also have engaged the services of Madison Specs that also can help answer questions and stuff like that. If you want to know if you have that situation, you can also reach out to me at julie@seattleiinvestorsclub.com. And other than that, I will remind you guys as we wrap up here, we want to thank Yonah. Thank you so much for taking the time, being so far away with us today. It makes us cool that we can talk to people all around the world, no matter where they're at, modern world we live in. But if you want to come hang out with us in person, everybody, you guys can do that as well. We meet every Tuesday from 12 p.m. to 2 p.m. in Burien at Angelo's, which is an Italian restaurant that has an awesome menu that we get to share some lunch, and we sit around the table and actually talk to each other face to face. It's a very, very powerful and engaging environment. I hope that you all come one time and check it out. We are in late July going to be launching a handful of different locations to make it easier for everybody, no matter where you're at, to get to around the, greater, King, Snohomish, Pierce County areas. But other than that, 12 p.m. to 2 p.m., hope to see you there. It's every Tuesday. You can go on to meetups and just search for Seattle Investors Club, and you'll find those if you want to RSVP, or you don't have to. You can just show up. And Yonah, maybe next time you're in Seattle, if you ever get out this way. Have you ever been out to Seattle?
I have been in Seattle. It's been way too long.
Yeah. Well, I know between some of our friends that talk to you on a regular basis, who all have podcasts and meetups, that maybe someday we'll be twisting your arm to come out and do an in-person event for sure. So again, thanks for coming today. And Joe, where can everybody find the details of today's podcast?
Yeah, the details and all the show notes and the links can be found at seattleinvestorsclub.com/82. That's seattleinvestorsclub.com/82. And if you like what we're doing, make sure you hit the subscribe button. You can do that for free. And also, we love reviews. So if you feel like giving us a review, we would love you for it.
Good stuff. Well, Yonah, thanks again, and safe travels on your way back to the USA whenever you're going to be doing that in the next while. And we'll talk to you again.
Okay. Thanks, guys.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.